Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money color commentator, Steve Savant.
Well, welcome everyone to Right on the Money. Today we're talking about the proper use of annuities and retirement planning. And to help us understand the annuities is author, popular platform speaker, and certified annuity specialist, Liz Cornell. Welcome to the show, Liz.
Thanks for having me.
Well, Liz, you're all the way in you flew in from Florida. I really appreciate that. I was checking out your two Forbes articles.
Yes.
I have to say, your career has really taken off. I want to talk to our audience about an anomaly, because not only are you a certified annuity specialist, but you're one of the top 30 under 30, and yet your audience, your predominant client base is baby boomers.
Yes.
Talk a little about that.
I enjoy it. Yes, I get that it's a little bit of an anomaly, but I think it's just what I was born, bred, in what I'm here to do, and I love it.
Well, let's do the basic entry level. Let's say we don't know anything about annuities. What is an annuity?
An annuity, I guess in its simplest form, it is a lump sum of money for return payment or income. So if you think about Social Security or even a pension, which most people are familiar with if you have companies that offer those still, but it's basically lump sum of money, they give you income.
So let's say that I'm not versed in annuities. I don't know if I should buy them or not. Who is the clientele? What is the actual suitability for a client? Who are you looking for?
Really, you want to look for folks who are retired, approaching retirement, or even thinking about retired, which I think is most people. So a lot of people would be surprised that annuities really cover a broad spectrum now. It's not so compartmentalized to only someone who is retired. It's certainly something that needs to be a part of a full portfolio planning, if you will, full comprehensive planning. It doesn't have to be the only solution, but it is absolutely something that needs to be considered.
Well, I'd like to know, because I know that there's fixed interest annuities. I know that there's indexed annuities. I know there's even sub-account annuities. But underneath all three chassis, they're pretty much the same, the basic structure. Talk about that.
Yeah, absolutely. And that's a great way to put it. There are three basic types of annuities. You have a fixed annuity, which kind of functions like a bank CD held at an insurance company, fixed interest rate, fixed period of time. You have the index annuities, which are you're not directly invested into a market. You are simply tracking one.
No, let me stop you there for a second. I've noticed that 72% of the annuity index market is using only the S&P 500.
Yeah, and that is absolutely true. Each company, each carrier, each product has different indices that you are allowed to follow. So in picking products and what you think you want to work with, that's certainly something to consider.
I noticed in one of the lists you showed me that we have not only domestic indices, but we could also, there's access to a global market with foreign indices.
Yeah, absolutely. You can get just about anything you want to. It's just a matter of taking a little bit more time, because the annuities do take a little more time to understand. You can't compare them to every other investment on the marketplace. So as long as you take a little bit of time to understand it and the options that are available, they are contractual guarantees. So you have to be a little more deliberate with what you're picking.
Okay, so with guarantees, I'm really giving myself a little bit of comfort from a retirement point of view. If I'm looking at retirement, sometimes our seniors are looking for something a little more conservative, maybe not so much market driven. Do you find that is probably why maybe annuities have such an appeal?
Oh, yeah, absolutely. I think there is a harmonious balance of both. And really, it just boils down to preferences. I tell people this all the time. There's no right and wrong decision with your financial choices. No one is ever going to tell you that what you're doing is a good idea. I use the analogy, it's like you're going to go out and play golf with your friends and say, hey, this is what I'm doing with your money. They're not going to be, or tell you, hey, let's stop what we're doing. Let's get off the golf course and we will go down to whomever, because I want to put all of my money with what that person is doing. So a lot of it's just personal preferences. It is personal choices. Annuities play their role in most people's portfolio, but they have to really understand it, and it has to identify with who they are. It's not right and wrong. It's just being more deliberate, especially because in the annuity platform, you have to pick product.
Okay, now let's say, because we have, if I'm understanding this correctly, we have three crediting methods. We've cited the interest rate, the indexing, and the sub-accounts. People have to kind of be suitable for this. They're going to have to kind of probably take some kind of a risk tolerance test, or probably get in the game to understand where they want to go on this.
Yeah, absolutely. It's with anything outside of annuities. You have to I guess the biggest part of what my job and what I do is helping people articulate what they like and what they don't like. And you have to be comfortable saying, I don't like this, I don't like that. There is nothing wrong within your preferences, but you should never push yourself to take on more risk or being even more conservative than what you're comfortable with because somebody else is dictating it. So again, it just circles back around to take a little bit more time with it. They all serve their purpose. You can get just about anything you want to, but again, it takes a little more time.
Remember, if you say, Steve, I hear you talk about risk tolerance all the time. If you want to order the test, I'll give it to you. Just write me at steve@onthemoneyshow.com, and I'll be happy to send it to you. When we're talking about suitability issues and we've made our choice, we finally figured out, it's kind of like Shakespeare, to thy own self be true, right? I have to be true to myself. I've taken my test, and now I have a timeline I've snapped. I know I'm going to retire at a certain date, right? So we see the future. But I'm not so sure how long I'm going to need it. I mean,
I call that getting promoted because I think dying sounds morbid.
Oh, it sounds morbid. So you're saying getting promoted?
We're getting
now.
promoted. It's a positive.
So we're not dying.
Yeah, we're getting promoted.
We're not not passing.
Right.
We're getting promoted.
Right.
Okay. Well, let's just talk about our promotion date then.
Yes.
Okay. How about that? So on our promotion, a lot of people say, well, Steve, I don't know how long I'm going to live. You think about this. Jean Clement the Guinness Book of World Records lived 122 years, 164 days. And I think people in the millennial generation are going to see age 100, especially female in good health. Oh my goodness. I think you guys are going to see 100 years all day long.
I will be here till I'm 150.
150?
Yes.
I can't believe you said that because Professor Aubrey de Grey, a European professor in gerontology, says that a person that will live 150 years has already been born.
I agree. I'm here.
And it's
yes, you're welcome.
I'm glad. Okay. I'm glad. Well, I got to figure that out. Okay. So let's talk about this, Liz. I have deferred annuities. I don't need them right away. I have immediate annuities. So what am I looking at when I'm still in the retirement mode of accumulation?
Really what you're trying to determine is when you want to take income. No matter what financial objective you have, everybody is chasing income, right? I want to get growth. Well, why do you want growth? Well, because I want more money. Well, why do you want more money? Well, you want growth because you want more money for later. Right? Mm-hmm. I want to protect what I have. Well, why? Well, in case I need it. Well, why? Well, just in case, world comes to an end, I have my money sitting there. So you have to articulate when and where you want to use things. And annuities are the only thing on the planet that are contractually bound and contractually guarantee that you can get this income no matter what, right? They're insurance products, basically because if you live to be 150, it's always going to be there. You should, however, kind of predetermine when and where you think you want to use it. It's not to say it can't be deviated from. Obviously, something deferred is probably priced for using something later. It's not to say you don't have the option of using it sooner, but you should have a clearer plan going into it on which route you want to go.
Yeah, but the one thing you just said I think is really important is people are not using deferred annuities just to defer and pass it on to the next generation.
Yeah.
I think what I've heard you correctly is you should be thinking about a deferred annuity. Sometime in the future, you're going to annuitize or maybe take a time certain, whatever. You're going to use this for income.
Well, yeah, absolutely. And that's with any investment, right? I mean, by human nature, we naturally compartmentalize things. We look at our portfolios, regardless of investment it is that you have there, and say, okay, I'm going to use this money at this point in time. And if these things don't happen or do happen, then I'm going to switch to this money and use that for this point in time. By nature, we already do that. The nice part about the annuities is it eliminates really the question of who, what, where, when, why, if you will, because it's already there. It's contractually guaranteed, and they are bound to adhering to that.
Okay, when you're teaching, and you're a popular platform speaker, you teach on this all the time. When I'm looking for something for a senior, a person who's already retired, too late for him?
No, absolutely not. Once you get to retirement, most people feel like they have this finite number, right? Like, I have retired, I have this number, and now I have to make it work, and now I have to make it last. Ultimately, you are chasing income in retirement. So again, it circles back around with using annuities with where they fit within your own personal preferences and what makes sense. So if you're already retired, of course you should be considering annuities. You're trying to get income, right?
Guaranteed income.
Guaranteed income, yeah, absolutely.
And guaranteed income I can't outlive.
Right.
Now, that mantra is huge because when I think about guaranteed income I can't outlive, and you live to Jean Clement's 122 years, I mean, that is some serious, serious mortality. And I have to say, Think about it. The millennial generation could be the first generation that has dominant centurions built within their demographics. Remember, if you're listening to our show on radio, iTunes, podcast, you can view our video version right on themoneyshow.com and request any of the information from our segment. We'll be right back with Liz Cornell. The number one fear of American seniors is outliving their money in retirement. Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. The Guinness Book of World Records for living the longest is held by Gene Kalman, who lived 122 years, 164 days. And that's a fact. But it seems like science fiction to consider living to age 150. But according to a leading gerontologist, that person has already been born. Every day in America, seniors are turning age 100. It's the fastest growing segment among retirees today. And tomorrow, you may very well be one of them. Could your retirement plan go beyond age 90, age 95, or even age 100? Now you can purchase guaranteed lifetime income no matter how long you live. And that income can also include annual increases to help maintain the purchasing power of your retirement dollar. So just go to www.rightonthemoneyshow.com and click on the free income calculator to determine how much guaranteed lifetime income you can purchase. Well, welcome back to Right on the Money. I'm Steve Savant, syndicated financial columnist and money color commentator. In this segment, we're talking about annuity riders and what they can do for you with Liz Cornell, author, popular platform speaker, and certified annuity specialist. Hey, I have to ask you, just because my audience will, what is a certified annuity specialist?
That means that I know everything. I'm just kidding.
Wow.
That just means that my niche, my specialty is specifically within the annuity products themselves. So riders, which is what we're going to be talking about here shortly, the products themselves, the different types, where they make sense, where they don't make sense, and where to position them within somebody's retirement plan.
Now, a rider, if I understand this correctly, is kind of like an adjunct onto the contract. You know, you're going to add something onto it. Some of these riders there could be a cost behind it.
Yeah,
Some
absolutely.
of them are embedded in the contract. We're not really sure. It depends upon what we're talking about. Give me a rider that you'd say, Steve, when you're thinking about annuities, you should consider this rider.
Well, first and foremost, especially because they're popular with the geriatric community, you should be looking at products that have a long-term, I say long-term care rider, but something, unfortunately, as you get older, things come up medically that you just don't anticipate. That's just part of, I guess, aging. And
By the way, I just saw, and I don't mean to rebel this, but I just saw an article that said the average baby boomer will spend about $250,000 over their entire retirement based only on medical issues. So, wow. So I totally get that.
Oh, yeah, absolutely. And one of the biggest concerns with folks is if something comes up and I need access to that money, that I don't have it. And that's not true. I would say most products on the marketplace today have some provision, some rider that says if you can't perform 2 acts of daily living, if you get confined to a nursing home, if you need home health care or you get are diagnosed terminally ill or critically ill, that they will give you access to more money than what the underlying contract may provide, and or pay you more depending on what it's attached to.
All right, so let's just think about this. Yes, I think that's a worthy rider to consider. If I'm thinking about this as a long-term care expenditure, they may be able to give me money. I don't have to worry about my annuitization. Maybe I can get out of it if I'm getting payments, because there's certain things that can trigger those riders to intervene and then supply us with this funding. Like, again, for your example, long-term care.
Oh, yeah, absolutely. And I will give the insurance companies a lot of credit for this, that they've come a long way, especially in the last probably 10 or 15 years. And they understand, they kind of get it now that, yes, things come up, things you don't foresee. And especially because these products are popular with the geriatric or retirement community, that they need to have those provisions in them. And so they get it. Most of the products now that are available have some sort of provision in them in one way or another that allows you access to more money in the event that comes up. And that's one of the biggest concerns.
Now, you mentioned, of course, we mentioned long-term care, but I think you mentioned even imminent death. If you knew you were going to die, did I hear you right on that? There's actually some provisions or maybe a rider that could actually say, hey, I know you're not going to live for the rest of your life. We'll go ahead and then expedite whatever's left in your payment?
Oh, yeah, absolutely. You just have to tell me when you're going to die or get promoted.
Well, I don't know when that's going to happen. However, I have noticed that the new 2012 mortality tables for annuities just was released in 2016. And because we're living longer, I noticed that mortality credits, the secret sauce of annuities, so to speak, the alpha of annuities, has really going to be, it's going to be decreased. And so the payments are going to be a little bit because we're living longer.
Yeah, absolutely. So if you're considering or looking into annuity products, now is the time to do it. Yes, people are living longer. I think that's good news. The bad news, as far as what I specialize in, of course, yeah, it affects the amount of payment that it is that you're going to get and how they price things within the product.
When we're talking about other riders, here's one I think this is a huge one. Just this year, 2016, Social Security, we were notified of everybody, if you're receiving your Social Security, you are not getting a bump up for inflation this year. So I've noticed that we have some options in annuities to actually add on a rider, a cost of living adjustment rider that we can put on our annuities and actually guarantee an increase every year.
Oh, yeah, absolutely. And that's one of the biggest things, retirement planning, outside of annuities or not, that you should be planning for. One of the biggest benefits of the annuities is that it guarantees that that will happen. So, yes.
So let's talk about why you think this is going to be a powerful tool for using a rider, especially a cost of living rider. I'm thinking, I saw a couple of weeks ago, we were out there, I saw a couple of them that were actually paying, you could get as high as 5-6%.
Oh, yeah, absolutely. And that's one of the biggest things, outside of annuities or not, that people should be planning for. Again, it's having annuities as part of your overall plan, especially in retirement, because in retirement, having that income and being able to cover your monthly expenses, but also that you're keeping up with inflation, right? Milk may cost $1 more a few years from now. And though the CPI says we don't have any inflation, I mean, most of us could probably say that things cost more than
Well, I know they say that, but my gasoline bill, well, gas right now is pretty good right now. But I mean, you know, we're tied to groceries, gasoline, utilities. Those things all cost money in retirement, and people are already they're figuring out what their lifestyle are going to be for this. Now I'm thinking about the annuity. I'm going to get back to the inflation. Okay, so let's say we buy an annuity, and we have the privilege of making an annuitization, or even buying it. I guess I've heard that you have, not only you could annuitize it for your life, but you could buy it in 10-year certains, or 15-year certains, or 20-year certains.
Oh, yeah. And to articulate that a little bit further, with any annuity, you have basic ways for taking out your money. I mean, that's what the annuity contract is itself. It is a contract that tells you all of the ways that you can take money out of your annuity. A couple of options. One is being an annuitization, which I say it's kind of the oldest form of using an annuity. It's how it's been done for a really, really long time. But on the rider topic, there are these riders that have been introduced that you don't have to do an annuitization. An annuitization, in its simplest form, it is basically a irrevocable decision for taking income. That's not to say that nothing goes to your beneficiaries, depending on what option it is that you pick. It's not to say that it is a bad thing. And I like to make sure that this is clarified, that in annuitization, it is a right within a contract. It is not an obligation. It is something you never have to exercise if you don't want to.
Okay, well, what's the option if I don't want to, and I still want to be able to get some income?
Oh, yeah. Electing an income rider. And income riders are the same basic principle, but the consumer stays in control of their money. It's yours. It's not the insurance companies. And to me, capital long-term is your flexibility, right? Things come up, things change. It's great that you're getting this income from this account, but something unforeseen comes down the road. You need to be able to take that cash out. Again, for medical reasons, who knows? You need to move. Whatever the case may be, and having that capital there and having the income rider that can still guarantee that lifetime income. But if you change your mind, if something comes up along the way that you didn't prepare for, you do still have access to that money and you can pull it out if necessary.
Well, one of the gripes about annuities is that they're not liquid, but I've heard you talk about, listen, there's 10% withdrawal. Talk about that.
Oh, yeah. I think the biggest oxymoron to me is that people with annuities, and I ask this at my workshop, the class that I do, and I say, why won't you buy an annuity? And the first person always says, well, because I can't get my money out. Now, the irony of that statement is an annuity is the only thing on the planet that is designed to give you your money. That entire contract is basically all of the ways that you can get your money. And in order for you to really leverage that, again, you have to be more deliberate with product that you pick and how you want to take those distributions, because they're all priced to do something a little bit more specifically. So a 10% free withdrawal. I would say 90% of all annuity contracts on the planet today will allow you to take at least 10% penalty free every single year during a surrender schedule. You don't have to exercise it if you don't want to. It's not to say that it's the only way that you can take money out of your contract. But most annuities have provisions in them that give you your money. It's just a matter each year of determining which one you want to use.
Now, you just mentioned surrender schedule. Why don't you mention that before we go to the break?
Oh, yeah. Surrender schedule, and this is how I explain it, is that it's basically the commitment, how long we tell the insurance company we're going to keep our money with them, right? Because the insurance companies, they make money reinvesting your money, right? So they need to know how long are we going to have that money so that we can reinvest it and be profitable as a company, right? In order for them to do that, they need a commitment from the consumer, right? So a surrender schedule, and how I explain it, is just it is the basic amount of time that you tell the insurance company you will keep the bulk of your account with them. It's not to say you don't have access to your money. It's not to say you cannot take money out sooner, but it's the length of time we tell the insurance company as a consumer we will keep our money with them. Now, if we choose to leave early, yes, there is a penalty.
Now, they can be stiff. I mean, right? I mean, it could be a nickel. It could be 7%. I mean, there's some big numbers out there.
Yeah, absolutely. I tell people this all the time. The longer the surrender schedule, the better the product probably is, okay? To me, it's just basic math. If an insurance company has a longer commitment from you, they're probably going to pay you better interest. They're probably going to have better income benefits. But again, it comes back to being more deliberate within your product picking. Every carrier, every product is priced for something. So you have to be more deliberate. Again, I keep using that word, in that I am picking this product to do this thing.
So it sounds like I can buy any kind of period.
Oh, yeah, absolutely. You can get anything you want to in the open marketplace today.
Well, remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. In our third segment, we're going to talk about how annuities are titled and taxed with Liz Cornell. The Guinness Book of World Records for living the longest is held by Gene Kelman, who lived 122 years, 164 days. Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. Will you live to be a super centenarian like Gene? Of course, no one knows how long they're going to live or if their family history will be any indication of their lifespan, especially in light of constant medical advancements. But the odds are ever increasing that a significant segment of seniors may live to age 100. But without some idea of your life expectancy, it's difficult to make plans for the future, especially for retirement. While there's no exact science in computing how long you live, you can get an idea by taking a life expectancy test. Then you can use the results to create a timeline for your own retirement plan. And don't forget, when you take the life expectancy test, always answer the questions honestly. So go to www.rightonthemoneyshow.com and click on the free life expectancy calculator and get an idea if you're really ready for retirement. Well, welcome back to Right on the Money. I'm Steve Savant, syndicated financial columnist and money color commentator. In this segment, we're talking about how annuities are titled and taxed with Liz Cornell, author, popular platform speaker, and certified annuity specialist. You're also kind of a historian on this annuity stuff, I heard, before we get into the title and tax issues. Talk to me about this. I mean, somebody told me, I thought annuities were like, a couple hundred years old, and I think you told me off the set. Are you kidding, Steve? The Roman Empire started this 2,000 years ago.
Yes, annuities have been around, the concept of them, for thousands and thousands and thousands of years. It's just that the life insurance industry decided to get involved about 200 years ago, and now we have the product platform that we do.
Well, when I'm thinking about this, I'm looking at different things. I noticed that this Roman judge in 222 AD, 225 actually, he actually had some kind of a mortality table, for lack of a better way of explaining it, that helped Roman troops so they could actually have some benefits for their surviving families, for their wife and their children.
Yeah, it was basically a pension. The Roman Empire wanted to say, hey, thank you for your service. We've got some money here, and if you come and work with us, we will pay you an income for as long as you're alive.
I'm looking at this. The British Empire in the 1700s, the actual parliament authorized annuities, and it became very popular with European high society as a form of prevention from any fall of grace, economic fall of grace, or any hard times. That was always their underpinning no matter what else would happen.
Oh, yes. And it sounds kind of ironic. It was a betting pool amongst these upper elite aristocrats on whose money they thought they were going to get and who was going to die first. They all put money. They were private pools. Obviously, the life insurance industry wasn't involved at that time. And they all started taking an income payment based on their mortality, much like back in 225, how long we think everyone's going to live. And if somebody got promoted, I like to call it, they would pay out a higher income payment.
Okay, so we have a history here. This isn't something we invented in the 20th century. This has been around for a couple thousand years, a couple millennia, in some relative form or another. So let's talk about titling. I always think about this because this is an area where consumers have some bit of trepidation. We have the annuitant, we have the owner of the policy, and we also have the beneficiary of the policy. kind of break me down what's going on here, because we want to be able to title this right.
Absolutely. And I want to take that a further step back and really see that the tax status of the money dictates how it should be titled. Also, your legacy you want to leave, how you want money to be distributed later, should be taken into consideration. So the annuitant is the live, breathing person. They are the ones that are entitled to the contractual guarantees for income, and it is based off of their lifetime. The owner is the entity or the person who owns the contract, owns the account itself. It doesn't necessarily have to be the live, breathing person.
Now, well, can I ask you a question on that? So the owner, policy owner, annuity policy owner, that's the person that's connected to the tax situation. Is that the way I understood that?
I would articulate that a little bit further and say that how it is titled, the tax status of the money should be considered. It doesn't solely dictate it, but to your point, with an IRA, right, individual retirement account, that is you. You're the only person who can own it. You and your spouse cannot joint own it because IRAs do not allow for that.
So when I'm looking for titling, it could be my qualified plan. You're just bringing that up. That's another issue. I could have this in my qualified plan. Now, remember, I've heard people quandary, advisors go back and forth on this. Hey, should annuity be in a qualified plan? Should it not? What's your thoughts?
I think it's one of those comments that makes me crazy, because if you get online and Google, there are just as many articles that say you shouldn't buy an annuity with IRA or tax deferred money because the money is already tax deferred, which really to me makes absolutely no sense. That has nothing to do with anything. An IRA, a 401k, a 403b is already an annuity within itself. Okay. First and foremost, most people cannot access that money prior to 59 and a half already. So you've already got rules on how it is you're supposed to take that money out. Now, after 59 and a half, you can do what you want to with it. If you're not taking from it, though, at that time, the IRS says that at 70 and a half, you have to start taking distributions. You have to start whether you want to or not. That's basically what an annuity is. It is tax deferred money. You have to start taking out at some point, which you have to do with an IRA anyway. And most people feel that within an annuity, well, I have all these rules for how I have access to the money. Well, you already have that anyway. IRAs, qualified retirement plans, 403bs, 401ks, are some of the best money to put into an annuity because you're already leveraging what you have to do.
When I'm thinking about qualified plans, especially when you said 70 and a half, I'm thinking of all of the seniors that are sitting here knowing that, hey, listen, I have to take mandatory required minimum distributions at 70 and a half. If I don't, we're looking at some serious penalties.
Oh, yeah, absolutely.
So I have to match up my annuity with that 70 and a half to make sure that my required minimum distributions are going to be matched up with the annuitization if I use that tactic.
Sure, and you don't have to do that. A lot of times with folks, for the planning that we do, let's say that you have an IRA, and yes, you have to take this requirement of distribution. So you can take a portion of that money, and within the contractual bounds, guarantee that that requirement of distribution is always going to be there, whether the payments supersede what you initially put in. A lot of times you can guarantee that that income is going to be there for your spouse, even if what they take out supersedes what you initially put in. Then you can take the rest of the IRA and go invest it in whatever else. Okay,
so if I have multiple contracts, usually I've seen some annuity companies actually send you the RMD, the actual, here's your number off your actual annuity if that's the only thing you have.
Yes, you get a fair market value statement at the end of every year that says, hey, this is what your IRA was worth on December 31st of previous year, and that's what the IRS uses to say, hey, here's how much money you need to pay out the next year.
I've heard you talk about this little kind of a side issue, because we're talking about when you're titling an ownership. I'm doing it for my beneficiary. I'm the annuitant, a live person, as you've said before. I'm looking also, beneficiaries. I want to have this go into perpetuate, into forever and generation after generation. I know you went to Ed Slott's university. He's really a sharp guy. I heard you can bump this out you could actually have some owner or beneficiaries that could go into your next generation.
Yeah, it's a stretch IRA. It is certainly something on the forefront right now that, depending on what the government does, may or may not be there for the next 100 years. But yes, they can take that IRA money, which is tax-deferred money, right? It's money we've never paid the taxes on, and your kids can take that money and continue, yes, depending on how old you are when you get what I call getting promoted. They may have to take requirement distributions for their lifetime, but they don't have to pay all of the income tax on it at once. They don't have to pay it in a lump sum. They can do a beneficiary or stretch IRA.
Okay, now when we're talking about taxes, and I always think about qualified money, there's no basis left. Once it's in there, you're paying ordinary income tax at whatever your effective tax bracket is. So that's pretty straight up. But if I have non-qualified annuities, right? Well, I got some basis play here, and I've noticed an anomaly that doesn't happen with hardly any other product, which is if I annuitize that, they kind of give you part of your basis and part of your earnings at the front end.
Yes.
I've never seen that before. Most products, it's LIFO, last in, first out taxation. You can't get your basis until later.
Yes, and if you do an actual true annuitization, non-qualified money is like what you have in a checking or savings account. They don't send you a 1099 and say, hey, you took $5,000 out of your checking account and you have to pay taxes on that because you've already done that. So within an annuity, when they distribute the money back via an annuitization, they pay you back some of what you initially put in, or what's called your cost basis, and a little portion of that payment is interest. And so you're able to spread it out over a longer period of time, and in that case can ultimately end up paying a smaller amount in taxes and end up netting more to yourself over time. I mean, at the end of the day, taxes are the name of the game. Mm-hmm. How much money am I netting? You know, it's great if you have a $5 million IRA, but that's not all your money. Mm-hmm. You're going to pay taxes on it at some point. Somebody else is going to pay taxes on it at some point. That is not all your money. So it is important to be mindful of when you are taking this money out and distributing it back to yourself, how much am I actually netting? And using non-qualified money via the provisions within an annuity contract that take that interest and spread it out, you can end up netting more to yourself over your lifetime and or someone else's.
Well, it's a very big consideration for our clients that are listening today, our customers that are hearing us out, that, you know, you should have a little bit of tax diversity. You'll have your qualified plans, which you know are going to be taxed. There's no basis left, as well as having non-qualified monies. And I love the annuity idea, especially because when if I did annuitize it, I'm getting my basis, which is unheard of. Part of my basis is coming back to me every year until we recapture it.
Yes, and the interest grows tax deferred. So let's say you didn't want to do an annuitization, that you fall in the category of, I want to purchase an annuity with some money that I have sitting in a CD because I want to earn more interest, right, than what the banks are paying, which is basically next to nothing.
Right now,
even in that case, the interest grows tax deferred. So unlike a CD where you get that 1099 every single year, whether you take the interest out or not, that interest grows tax deferred. So even if you don't want to do an annuitization, that's not your objective, you're just looking for somewhere to put money, an annuity is a great place to do that because the interest that you pull out is not taxed until you start taking it out.
Well, remember, if you're listening to our show on radio, iTunes, or a podcast, you can view our video version online at rightonthemoneyshow.com and request information from this segment. In our first segment, we're going to talk about distribution options and how to shop for income with Liz Cornell. Over 50% of those who have life insurance may be in the wrong rate class and more than likely are paying too much for their coverage. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. Sometimes you just need a second opinion to determine if you're actually getting the best deal. The insurance industry has just updated the mortality tables to reflect longer life expectancy, so premiums are expected to go down. And additionally, there are life insurance companies that are more benevolent if you have a medical problem than other companies. And when you consider that most life insurance companies offer lifestyle credits for those who practice good living habits, well, you could save a lot. But an additional value here is the vast majority of life insurance companies offer a free blood and urine analysis, a test that costs hundreds of dollars and with no obligation to buy. With hundreds of life insurance companies competing for your business, you could pay substantially less. So if you have a life insurance policy and you want a second opinion, just go to www.rightonthemoneyshow.com and click on the life insurance for a second opinion. Well, welcome back to Right on the Money. I'm Steve Savant, syndicated financial columnist and money color commentator. In this segment, we're talking about distribution options and how to shop for income with Liz Cornell, author, popular platform speaker, and certified annuity specialist. You know, there is so much in annuity. You got to be a specialist. Huh? I mean, how can you keep track of all this? It seems like it's a really deep subject.
Oh, yeah. I use the analogy, you can't be an expert at everything. So I live, die, breathe, and sleep by the annuity contracts, the insurance industry, and I absolutely love it. And so, yes, I specialize in
you
just
partner
that.
with a lot of advisors because you don't do money management. You outsource that to the other people who maybe do long-term care. You outsource that to other people. So your area, your niche is really annuity income.
Yes, absolutely. And I'm not one of those two. Every investment serves its purpose, whether it's an annuity contract, a stock, a bond. They all have a function of what it is that they do. It's a matter within your own preferences, picking and determining what things you want to do.
Well, here's what I want to do. I want to talk about income in this section, and I know there's a potpourri of way to play here. Let's talk about the three basic ideas. Single premium immediate annuity. This is for a person who knows that they're going to need money right away. I'm not saying it's good, it's bad. You have to do the math for yourself, but you're going to get it, and you're going to have that money within about a year. I might want to do a deferred income annuity, which I have to wait for a year before I can take it out. And I'm just looking at different options: guaranteed withdrawal benefits, a rider. These are three different ways I could actually start generating income.
Yes, and each carrier, each product, each company prices those products for doing something specifically. Again, it boils down to your personal preferences.
Liz, I'm going to stop you there because I'm curious about this. All these companies are fishing out of the same U.S. debenture pool. They're all buying U.S. government, for the most part, high investment yield bonds. I mean, they're usually investment grade. So everybody's fishing out of the same pool. So why is the income for like a 10-year certain or maybe a life annuitization, why do they all differ from carrier to carrier?
Well, each company has their own philosophy and in how they want to price things for even their general account, what they want, which is what essentially your money goes into. It's like a bank CD. You give your money to the bank, they have it, it goes into, say, a general account, and they lend it out so that somebody can purchase a car, get a mortgage, or they want to get a business loan, et cetera. It's the same kind of concept on the annuities. Yes, it's your money. You put it in there. It goes into their general account, and that's what they're reinvesting in, exactly what it is that you're talking about. But each company have their own actuaries, and they all have a business philosophy, whether it's short-term, long-term, and how they want these products specifically within the product portfolio that they offer, what they want each of them to do.
Well, I find it interesting. About a year ago, the United States government, and this was their idea, not ours, actually chose deferred income annuity to be part of the QLAC scenario, which is qualified longevity annuity contract, to give people the ability to defer and delay portions of their RMDs for retirement. And to me, mind-blowing.
Yes.
This is a government's idea. We didn't bring this up.
Yes. Well, I think the government's just finally catching up to what is actually a really good idea.
Well, think about this. We'll walk through this. If I have a deferred annuity, this is just one income option. If I have a deferred income annuity, I don't have to buy it in one contract. I could actually buy it in sequence. Like, hey, I'll start the next one at 70 and for the rest of my life, or maybe 75 in the rest of my life, and start another one at 80. I could go all the way out, according to the regs, I could go all the way out to 85 and do this. That blows my mind.
And I call that comprehensive income planning. They cannot price everything into a product, meaning you can't get a 25% rate of return every single year and it be liquid and never touch anything when you go to take money out and pay for the kids and the grandkids all to go to college and, right? So annuities are the only thing on the planet that contractually guarantee this income. That's why they're considered insurance products,
well,
right?
I know of no annuities paying 25.
Yes, no, annuities do not pay 25%. I'm exaggerating, but I'm using that for an example. But yes, no, they don't pay 25%, but annuities are the only things that contractually bound and contractually guarantee. And quite frankly, the insurance industry has been here for a really long time, and they've been really successful at doing this.
No, well, now that I brought it up, right, I wanted you to talk the difference, because I think this is a contention issue among consumers. What's the difference between my payout rate and what am I really making rate of return?
Yes. So circling back around, we had talked about this a little bit earlier. You have three basic types of annuities. Okay. If you strip all of the fluff away, you have fixed, indexed, and variable annuities, right? Variable annuities are primarily invested in mutual funds. It's kind of like a brokerage account wrapped within an annuity contract. Fixed interest rates, fixed period of time, fixed annuity. Indexed annuity are fixed products because principal is protected. So you're not directly invested in an index itself. You are simply following it. The only thing that differentiates those three types of annuities is how your interest is earned and how principal is or is not protected. Now, outside of that, that's what your capital is doing. That's what your real money, your real dollars, when you get a statement and you say, Liz, how much real money do I have? Okay, that is dictated by which product it is or type of annuity that you have picked. Now, on the flip side of that, annuities also have these income guarantees. I use the illustration, and just as a disclaimer, this is solely to be an extreme so you can understand the concept. That it's like going to an advisor, a bank, or whomever, just going to a person and they say, okay, Steve, you've got $1 million. So here's what we're going to do. We're going to guarantee that based on the current value that you have, this $1 million, that we will give you $60,000 a year, right? Or the payout rate. Now, in order for us to guarantee that we're going to do that, you may only get a 4% rate of return. Okay, so yes, you are getting more income than what it is that you are earning each year. However, as long as you are alive, if you live to be 150 years old, we are always going to give you that $60,000. And if you really want, you can pass that on to your spouse as well. In its simplest form, that is what an annuity is. Now, how you get that $60,000 is dependent on which provisions in a contract you want to use, such as in annuitization, whether it is that you want to utilize the free withdrawals. But most of them now have these guaranteed minimum withdrawal benefits, which take the old platform of these annuitizations. They guarantee the lifetime income it is that someone's going to get without someone having to make this permanent, irrevocable decision, so that if something changes, you can go back and get your money out.
Okay, so when there's some flexibility here that you're bringing up that is really something you need to look at. That's what I'm getting from our discussion. Okay, so now I'm looking at the ability of when I'm looking at how the distribution's made. I can ladder, I can use SPIAs, I can use DIAs, single premium annuities, deferred income annuities, guaranteed withdrawal benefits. There's a lot to keep your head around. What about this issue about, I've noticed that some annuities sell for income, I have a roll-up rate or a kind of a bonus rate up front. What's that all about?
It could mean one of two things. A lot of annuities offer an upfront bonus, and yet it is an incentive from the carrier to buy the product, of course. They say, hey, Steve, you want to give us $100,000? We will give you, say, a $5,000 bonus. Yes, real money, real interest, real dollars, and that your account is real capital earning interest based off of the $105,000 versus the $100 you're giving in. Some semantics here, though, and a lot of times our people get confused talking about this roll-up rate. Guaranteed minimum withdrawal benefits, which we've touched on, are the income riders that are now available. Okay, it is the portion of the annuity that says no matter how your money performs or earns interest, dependent on the type that you pick, we will guarantee that for income purposes. And let me clarify that with my own clients, I use real money. You have real money and you have not real money. A not real money account, a guaranteed minimum withdrawal benefit, is basically, it's a phantom account attached to your contract, your real capital, your real dollars. It is a phantom account that is a calculation strictly for determining income. So I say it's semantics because a lot of times when you're reading through the contracts and the brochures that they give you, they talk about this bonus credit, and a lot of people think that that's real money, real dollars. It's not. It's a calculation for determining an income amount, and that's okay as long as you know that ahead of time.
Okay, so I just make sure I got it, straight here. So I'm taking my roll-up rate. So they say, hey, if you join today and buy our annuity, we might give you 6%, 7% bonus. But that bonus is only assigned to your total, which is only used for income purposes only, not actual cash surrender.
Correct. And again, it depends on carrier and it depends on product. Some of them, what's called your benefit base, when I talk about these phantom accounts, all it is, again, it's a calculation for determining income. So some products will credit you a real interest, real bonus credit to your real dollar amount at time of purchase, at time that you buy the product. The other side of that is that each year, if you purchase one of these phantom accounts, you can get a bonus credit each year. But again, you have to read between the lines a little bit and understand that that doesn't mean that it's a guaranteed real dollar, real rate of interest each year.
Well, I have to say I've seen some carriers charge for this. You get a little charge for whether it's on your phantom account or your real money, whole nother idea. Remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. In our fifth segment, we're going to talk about how to use annuities in retirement planning with Liz Cornell. We'll be right back right after the break. Shakespeare once said, "This above all, to thine own self be true." Hello, everyone. I'm Steve Savant, syndicated financial columnist and talk show host. It's difficult to make good decisions in life without knowing who you really are. And nowhere in life is this more important than making sound financial decisions. Creating a financial profile addressing your psychological disposition towards money is important, and that's a critical component in the decision-making process on saving, investing, and using insurance to protect against risk. Establishing your own risk tolerance is the first step in providing and building a financial profile so that you can measure your suitability for a financial product or a strategy. There may be many risk tolerance tests available to help you construct your own financial profile. One test that I use could be a good place for you to start, and I'll email it to you free and without obligation. The test will take about 10 minutes, and you'll be able to calculate the results in the comfort and privacy of your own home. So just go to www.rightonthemoneyshow.com and click on the free risk tolerance test. Once you calculate the results, you'll have an understanding of your attitude towards money. Well, welcome back to Right on the Money. I'm Steve Savant, syndicated financial columnist and money color commentator. And in this segment, we're talking about how to use annuities in retirement planning with Liz Cornell, author, popular platform speaker, and certified annuity specialist. Liz, really, people are looking at annuities more than they ever have. I mean, somehow we have arrived. Social Security is basically a annuity system. The QLAC, the Qualified Longevity Annuity Contract, the government came up with that using one of our products called a deferred income annuity. So everybody's kind of waking up to this new idea, and especially because we're going to be living longer. And I'm not really sure all my retirement. I have qualified monies in ETFs. I have qualified monies in money markets, but I don't know if the market where it's going to be. I need something for sure. I'm going to have bills in my retirement. I am.
But you have those anyway.
I have them now, but I'm going to have them in retirement too. It's not going to go away. And a lot of us that are going to head for retirement, we're looking at our lifestyle. Do we want to maintain that lifestyle? Who's going to pay for the flooring? When I'm building a retirement plan, I want to have what's going to pay my expenses. Oh, I want to go see those grandkids. I want to go on a vacation. So I need something I know is going to be there guaranteed to pick up my normal tab of domestic living and the vacations I want to see my kids and go on different trips. So I have to have this, and all of a sudden, annuities are the play.
Yeah, and I will say this too, and this comes from, it is an industry that I love and have a lot of respect for and am very proud to be a part of, but I think the insurance industry has finally arrived. Based on the last 10 to 12 years or so, the products have evolved to a place in that they're more flexible than they've ever been, and I really think the insurance companies get it, that the consumer, ultimately, we want to stay in charge of our money. We don't want somebody else telling us what it is that we're going to do with it. We want the comfort of knowing that wherever our money is, it's going to be in a good and safe place and within a safe industry. And I think the insurance companies really finally get that, and they now understand that, yes, consumers want to maintain that control, and they really allow you to do that.
Okay, so that's one of the things that you bring up in our series today is that, hey, listen, everybody thinks we're locked in. We can't move. These things are impenetrable. Once you started it, you can't do anything about it. You know, you're really buying forever issues. But you're saying there's a lot of flexibility here that it's kind of a misnomer.
Oh, yeah, that is absolutely not the case. And I spend my workshops and my classes really walking people through the nitty gritty of understanding that, in that, no, the products are more flexible than they've ever been. You can get, and I've said this before, that anything that you possibly want, but you have to understand that, you know, if you're picking a product that's a little bit more liquid, that has one of those return of premium provisions, which means that as soon as you put the money in, whatever you put in, you have access to the entire time. If you pick a product that has that, though, it may not have the world's greatest income benefits. Why? Because the insurance company has to look at this on a broader perspective and say, well, of all of the people who have this product and are able to leave, how many are actually going to do that? And they have to price the product accordingly. Same thing if you have a product that has the world's best income rider, which means that it has a big roll-up and a big payout. Well, if the product is wrapped in this income rider, well, you may not be able to take your premium out immediately when you put it in, because that's what it is priced for. So again, it circles back around to really understanding that each of these products and carriers are priced for something, and you can get anything that you want to on the marketplace today.
Okay, so there's a lot of flexibility, and there's multiple provisions in different annuities to actually fit and customize to your actual retirement.
Yes, typically you have to piece a couple carriers and products together so that overall, big picture, you're getting to happen what you want to have happen.
Well, let's go back to that, because I love that. I have a certain fantasy about my retirement, right? I have a certain, here's where I'm going to take my money. Pretty much have an idea maybe how long I'll live based on my health today and my expectation, my history of my family. Pretty much have all that down. So I can start to actually customize, if I'm hearing it correctly, customize an annuity platform, or maybe multiple annuities, depending upon what I want to do. And I could pretty much turn on and off income, get access if I need an emergency. There's a lot of things that we haven't talked about before in this regard with annuities, because it's changed so much.
Oh, yeah, yes. And especially in the annuity side of it, I guess that piece of picking products when you're going to retire is that with annuities, they just look a little bit different. A lot of people think if you're buying an annuity that you can't get growth, right? Well, ultimately, it just looks different within an annuity contract. So, for example, if I give you $100,000 and you pay me back $150,000, have I made money? Yes, of course. With annuities, growth is realized in distribution of the product. And that's a really hard concept for people to get, especially when they first retire, because we get conditioned for that 30 or 40 years. We put this money into this account, we contribute it, and we like to see our monthly value or our values go up every month or every quarter. I get it. I get really excited about it. And when you go to retire, to your point that you touched on earlier, yes, a lot of people feel like I've got this finite number and now I have to make this work. And annuity contracts are the only thing on this planet that no matter what decision anyone makes, for the most part, I can calculate it out, because all it is all the mathematical problems, if you will, for determining if a client makes this decision with this thing, this is how it affects all of this other stuff that I know without a shadow of a doubt, someone holding a gun to my head, if you will, what dollars are going to come out of that contract.
Well, if I'm looking at basically, our paradigm is changing on retirement, and part of it is it's not the accumulation of assets any longer. It's about income. You're buying income now. You're not buying. You're trying to not grow your assets. You're trying to actually to provide yourself with income that you cannot live. The number one fear in America right now today is outliving your money. And I'm thinking about when we have talked about this before. I mean, most of the female baby boomers that are in fantastic shape today are all going to be up in their 90s, maybe early 100s. I mean, that's astonishing to think. And those annuities, especially lifetime annuities, are going to pay out even if they become Jean Clement, the Guinness Book of World Records, 122 years. I mean, that's astonishing. So we've changed. It's income now, not so much accumulation of assets.
Well, yeah, and to put the fancy word on that, you said, people want to know that we're not going to outlive our money, right? Well, annuities, at the core of what they are, they're insurance products designed to insure against the risk of superannuation, or the risk of outliving your money. I tell folks this all the time. Longevity risk is one of the biggest parts of planning for retirement. So not so much how much money you have, but again, really you should be looking at, how long am I going to be here? And none of us have the crystal ball to know that. But really, on your best efforts, you should try to, yes, you can't calculate it out, but you should prepare for it and should know that. And the annuities are a great place to be able to go and do that, because at the very core of what it is that they do, it's what they're designed for.
I just want to suggest to our audience, too, remember, there are life expectancy reports. It's not a true science, but at least get you in the game and kind of establish a benchmark on when you think they're going to take your history involved, your behaviors, how you've been doing in certain arenas of diet and so forth. And that can actually get you in the game and kind of price when you think that you are going to, as you say, graduate, not pass or
Get
die.
promoted.
Get promoted, yes.
Yeah, and there's always going to be the outliers. I mean, that's just statistical data. But much to the life insurance industry's credit is they've got about 300 years of mortality tables for any reason anyone has died ever. So they're a really good place to go, because statistically speaking, they've probably got the most comprehensive data on determining how long it is we're going to be here for.
When I'm thinking about the last upgrade, I think about this in the 2001 standard operational tables. The actual average female is 88.8. That doesn't mean average so much as that. It means that half of those females will actually live longer than 88.8. So I think annuities need to be in place in a retirement, at least to make sure that I'm taking care of my domestic expenses that I'm going to have and I can't get around it. And especially a little, what I call the little jaunts you want to take, the vacations, go see the grandkids.
Well, yeah, and you can leverage income for other purposes. A lot of people forget that you get to retire because of the income, right? You have more income coming in than you need, and you save it. So the idea in retirement is if you can get things behaving in a way just like that. I retired because I had more income coming in than I needed. I saved it, and now I'm living off of it. So for us, that feels normal. Really, the idea in retirement is to get things behaving exactly that way. If you need $60,000 to live on, but you have $100,000 in guaranteed income, you don't have to spend the other $40,000.
No.
If you do, great. If you don't, reinvest it. It doesn't mean that money is just vanishing into thin air. Babe Ruth actually invested 100% of all of his money into annuities and avoided the entire 1929 blunder because of doing that. He has a quote, which I love, where he says, I may take risk in life, but I don't take risk with my money. And the last hard part of it is typically left off. And he said, because I invest in annuities and I don't have to worry. And his whole philosophy was that if I have more income than I need, I just reinvest as I go along. And over time, I am getting more.
Let's talk about that because you remember, an annuity contract is only as good as the carrier behind it. Talk to me a little bit about ratings and balance sheets.
Yeah, well, there are 4 basic ratings agencies that you can go to. Standard & Poor's, AM Best, Moody's, and Fitch. Now, what I actually look at is a Comdex score, which is something most people are not familiar with. A Comdex score, basically what they do is they take a numerical value. Now, an insurance company has to be rated with at least 2 of the 4 agencies that I just named. And to think that it's not political, they get rated on more than just how much money they have, how financially solvent they are. They get rated on new product, whether they like the CEOs or not, whether they like the infrastructure, if clients are complaining, if advisors are complaining, if advisors love them, if clients love them, and so on. It's not just compartmentalized to financials. So what Comdex does is they give this numerical value to the historical ratings of these companies. It's a 0 to a 100. So if a company has a 90 Comdex score, they are ranked higher or in the 90th percentile or higher than every other insurance company on the planet. So for getting a better, honest rating on these insurance companies, I encourage folks to look at a Comdex score.
Well, that's all the time we have for our show today. I want to thank Liz Cornell for being my guest. But before I go, remember what the good Reverend John Wesley once said: make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week right here on Right on the Money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.